now that we've talked a little bit about my opinions and my take on investment properties, I'm going to bring in the expert. I'm going to bring in Anthony Dionati with Silver Bay. Anthony, thanks for coming on the show today. Tell us a little bit about yourself.
Well, Scott, thank you for having me. I appreciate it. My background is in corporate finance. I used to work for Citigroup, and I've also worked for a private equity firm based out of Tampa.
Okay.
So, while I worked at Citigroup, I was in their real estate division, and we were managing 78 million square feet of real estate that Citigroup owned.
Wow.
So it was a lot of properties and a lot of work, and it was during that time that I was able to learn the business and really figure out, okay, where is the opportunity in this industry? And that's when I decided to start my own firm. And, just like every other real estate investor, we started with one property, one led into two into four, and so forth. And it's been a fun ride. We've definitely seen the ups and downs.
Sure.
But, the beauty about the business is you learn. And as long as you're learning, you will always do better in the future. So with that being said, we're in the Tampa Bay market right now. That's our main focus.
Mm-hmm.
And we are seeing a lot of opportunity in Hillsborough and Pinellas. But there's also opportunity in different markets that I want to talk about today. If you look 3-4 years ago,
mm-hmm.
when the market was at the peak, at the bottom,
right,
we saw a tremendous amount of inventory.
Oh yeah.
Okay, and the banks were begging you to take their inventory off their hands. It's a completely different market now.
I agree 100%.
And you mentioned something earlier. You said, you got all these TV shows and all these amateurs coming into the game. Well, that's a problem for the investor that's been in the business for a while, and I'll explain why. The problem that we're seeing is when there's too much competition, prices inflate. Acquisition prices inflate, which reduces your return on your investment, right? So, that's kind of what we're seeing happening in the marketplace. So what do we do to protect ourselves and our investors? Well, we are starting to look into different markets like Jacksonville,
mm-hmm.
Orlando. These are the markets that haven't really been tapped into as hard as you've seen deals happen in Miami and Tampa.
Yeah.
Because most of the money in Florida is coming from overseas in South America. The cash. We're talking cash right now. We're not talking about...
Right. I'm seeing a lot come out of Canada as well. I see a lot of cash deals out of Canada. Tremendous
amount of equity coming out of Canada as well. So that's kind of a brief of, my background and what we're doing.
So give me your take. Why invest in real estate? What's your opinion?
Well, everybody's different. I've always loved architecture, and I've always been fascinated by real estate. And I like the idea of touching and knowing that I can the subject property that I own is there.
It's a tangible benefit. Correct.
Whereas if I owned 5,000 shares of Apple and the stock market crashed, what's that worth?
Right.
So it's a different business model, and it's a model where, I'm a long-term investor, so
okay.
I want to make sure that the money that I have is placed in a secured vehicle where I see not only short-term gains, but also long-term gains. So that's why, I decided to move forward and focus my investments in the real estate industry.
All right. Well, that's great. So in your situation, how would you determine whether a property, because you said you're interested more in that long-term kind of aspect of it. Now, obviously, you're going to find properties, just like everybody, that's a good flip opportunity. Maybe it's something that's just got so much deferred maintenance, you could put a reasonable amount of money in it and the equity's there. How do you determine whether a property is a good buy or flip?
Sure, and that's a great question. And this goes back to, my background of being an analyst, because all we do is run numbers.
Right.
That's all we look at is we analyze key statistics, the interest rate, and another factor that we look into is building permits within the county
mm-hmm.
to see how many new constructions building permits are in effect. We also look at we count the inventory. We factor in supply and demand ratios. We also factor in comps, to see, okay, what kind of price difference are we seeing within the last 12 months?
And when you say comps are comparable sales,
correct,
what other similar homes in the market are selling for. So, if you've got a 3-bedroom, 2-bath, 2-car garage, you want to find something preferably within a mile to 2 miles that is also a 3-bedroom, 2-bath, 2-car garage with or without a pool.
The way we run our comparables, for a better lack of term, is the same way that the big banks run their comparables. Because at the end of the day, the property is going to be owned by a consumer, a retail buyer, right?
Mm-hmm.
And we're talking about flipping properties right now.
Right.
So when we look at foreclosures, we look to see, okay, where are we with price per square foot today? What is the retail value of that asset once all said and done? New kitchen, new floors, new roof, the whole shebang. And then we factor in to say, okay, how is the bank going to appraise this asset?
Right.
Because if we think it's worth $100,000, but the bank thinks it's worth $80,000, well, that's a huge spread.
Right. And 9 times out of 10, that person purchasing that flip property, the guy that's buying that house that you guys have fixed up, they're going to get financing. And when they come to me to get financing, that property has to appraise for the appropriate value. So in that exact scenario, if you're selling it, if say you bought it for $50,000, you put $15,000 in it, now you're turning around and selling it, or $20,000 in it, and you're going to sell it for $100,000. If it appraises for $80,000, I have to lend on the lower of the purchase contract or the appraised value. So if the appraisal comes in lower than the purchase contract, I'm stuck at that point. I have to go by that $80,000 value. Now, you as the seller don't have to agree to that, and you can go find another buyer. But what some people don't understand, in that price point specifically, a lot of these buyers are using FHA financing. One little caveat with FHA: once an appraisal is done, it's logged into FHA system, and that appraisal stays with that property for 6 months. So if somebody else comes along a month later and wants to buy that property using FHA financing, they're stuck with that $80,000 appraisal. So you got to really do your due diligence and do your homework.
And to elaborate more on that, I'll give you some statistics.
Great.
In August of 2015, 34% of transactions were cash-based, okay? And if you look at last year's statistics, that's a reduction of 9.6%. So what that's telling us is more and more consumers are coming to you guys for lending to get loans on the properties.
We like that, by the way.
Yeah. So we have to make sure that when we're underwriting these assets, that our numbers are pretty close to where you guys would come in and say, yes, these are the comps we would prefer to use. So it's not that it's a lot of work. It's just you really have to make sure that you factor in your variable cost.
Sure.
Because a lot of people will look at a foreclosure and say, "Oh, I can fix this for $20,000," but at the end of the day, they're probably in it for $35,000, maybe $40,000.
Right.
Yeah. So you really have to be careful. But it's just like any other business. Once you start with one, you learn, and you just get better and better at it. And and the other thing is, I want to throw in some other statistics for you. Okay. When I mentioned earlier that the market is changing, okay, last year, the amount of short sales that we saw compared to today, we have seen a reduction in 29%. So what that's telling us is the days of short sales and foreclosures are slowly diminishing.
That's good news. I think it's good news for the overall market and strength and stability of the market. I think that's good news.
Correct. But as an investor,
right,
our logic is saying, okay, so if this segment is diminishing, where do we go next?
Right.
Right? So the answer to that question is we start looking at new construction. So what you're going to start seeing a lot more of is a lot more of new construction, single-family, townhomes, condos, because the investment groups have pretty much digested close to about 80% of the inventory.
Sure.
And I'm talking about the Tampa Bay market right now. We're not talking about any other markets.
Well, and if you look back, and you look back, let's just go to 2005, 2004, 2005. That's really a big portion of what the market was back then. Before the housing bubble burst, ton of new construction. My house, new construction. You could buy a nice house for a reasonable price, and now I'm not talking about custom-built homes. I'm talking about tract homes, like the homes in the West Chase area and in Highland Park and other areas. That's the area I live in, so it comes to mind. Sure. But we're not talking about a teardown in South Tampa. That's a different animal. But when you're talking about a lot of that was really the market early 2000s. 2003, 2004, 2005. There were these little, gated communities. They were popping up everywhere, right? Construction. Lots of money going into building, and then all of a sudden the bubble burst, and all the money shifted to foreclosures, short sales, and things of that nature.
Yeah, it's a just if you look at history, it's a cyclical effect. We see this every 10, 15 years. As an investor, you have to sort of vision the future. Right? So you have to be able to sort of see what the market is going to look like 2 years from today.
So what do you think the market's going to look like 2, 5, 10 years from now? What do you think the housing market – let's just talk about the housing market here in Florida or Tampa. Let's talk I have my opinion. Sure. I know for me, my opinion is I'd like to see slow, sustainable growth. That's what I want to see. As I don't want us to get back in the position we were at before. But what do you think?
I agree with your statement. I think in the long run, Florida will see a long, sustainable, short-term growth rate. Okay, in the short run, you're going to see a tremendous amount of transactions happening because of the amount of inventory that we had in the short sale and foreclosure sector.
There's still some of that inventory out there, obviously.
There's still some out there, and there's more coming, but it's not as much as we saw 3-4 years ago. But look, as long as you factor in the economic indicators like the interest rate,
right,
and supply and demand,
which interest rates I think are going to stay low for plenty of time to come. So don't freak out about interest rates.
As long as rates stay low and there's more demand than supply, I think Tampa will be, we'll be fine. I love it here. People love Florida. We don't have a state income tax.
I love that.
So there's a lot of benefits to live in Florida. Yeah, and we have the beach, obviously.
I like that too.
You have the weather. So, in the long run, I think we're going to be great. I think there's a lot of opportunity in the short run as well. Yeah. So,
Well, I got to tell you, I agree with a lot of what you said, but just about everything you said. So, I want to thank Anthony for coming on the show today. You did a great job. You gave us a lot of good information.